Hey, good day, everyone. Bert Salazar here. Welcome to another Cambridge webcast. Today, we're going to have a short one, and this is going to be regarding required minimum distributions, or better known as RMDs. We hosted a really good seminar last week in Fort Lauderdale, Florida, and we had a lot of attendees. And whenever we do a taxes and retirement seminar, there's a lot of areas we touch upon and we cover regarding taxes and retirement. So we talked about the new tax law, and we did a comparison between the new tax laws and the old tax laws. We compared ordinary income taxes versus capital gains taxes. We went into details regarding provisional income calculations and the impact of Social Security benefits. We actually discussed sequencing of returns and what happens in retirement whenever there's a market crash, or if there's any type of stock market volatility and its impact in your ability to have a successful retirement life. We also had a really good conversation regarding Social Security and when do you qualify for Social Security benefits, and what are the best ways to take your Social Security distribution, the amounts, the timing, and all the other issues that are very critical. We also had a conversation regarding looking and viewing your financial decisions through a telescope as opposed to a microscope. The views are totally different. And obviously are things that are very critical for all of you and for all of us to consider when it comes to retirement distribution planning. What was truly interesting about this is that during the seminar, we have a section that we dedicate a good amount and quality of time to required minimum distributions. And although we did cover that in detail, we had so many different questions under RMDs that I thought it would be important for us to hold a webcast and make it available to all of you regarding some of the critical issues and concerns regarding required minimum distributions. Now, for those of you that are on this webcast, required minimum distributions apply to all of the qualified plans. And there are some exceptions, but the vast majority of qualified plans that you invest in. Now, the definition of a qualified plan is the type of plan where the money that you put in is actually put in on a pre-tax basis. The money grows tax deferred, and then when you pull the money out, you have to pay taxes on the whole things. So accounts like 401ks, IRAs, SEPs, simple IRAs, perhaps some of your pensions, like a defined benefit pension plan. All of these are 403B if you happen to work in the public sector or if you happen to work for nonprofit organizations. All of these plans come with certain rules and regulations that you need to abide by. So whenever you put money in a traditional 401k and IRA, and I'll just concentrate on those two because those are the ones that people are most familiar with. Whenever you put money into a 401k and an IRA, you have a number of rules that are going to be critical for you. The first one is known as the premature distribution rule, or the 10% rule, meaning that if you put money into a qualified plan, the money is supposed to grow tax deferred. And then in a perfect world, you would want to have access to that money after the age of 59 and a half. But if for some reason you need to take distributions out of your 401ks or IRAs, and you need to do so, and you don't qualify for, some of the exigent circumstances that may allow you to take money out of those plans without having to pay a penalty, then any distribution that you make out of your 401k and IRA, not only will you have to pay taxes on that distribution based on the tax bracket that you may find yourself in at that point in time, but also you're going to have to pay a 10% penalty. Now, once you meet that premature distribution and you hit the age of 59 and a half, then obviously you can start taking money out of that plan without having to pay that 10% penalty any longer. Now, there's another way that you may be able to take money out of an IRA without having to pay that 10% penalty, and that would be construed as a 72T distribution, but we don't have the time today to cover that. But that could be an option where, yes, you'll pay the tax on the distribution, but you may not be forced to pay the excise tax on that 10% penalty. Now, between the ages of 59 and a half and 70 and a half, you can do anything you want as far as taking distributions out of a qualified plan. 1 year, you may decide to take some money out of it. And the next year, you may want to allow the money to continue to grow tax deferred and take no distributions. And then the following year after that, you can pick and choose whatever it is you're going to do. The challenge is that in a qualified plan, once you get to the age of 70 and a half, whether you want to or not, you're going to have to start taking distributions. And the distributions after the age of 70 and a half can be very, very critical. And that's where we come in and we do a lot of provisional income calculations to make certain that you have the ability to not go above certain thresholds that the IRS is giving all of us in order to maximize our tax benefit under the code. Now, how do 70 and a half rules work? Well, number one, if you reach 70 and a half, let's say I were to reach 70 and a half in 2018. That means that I'm going to have to start taking a required minimum distribution. Now, the way that the required minimum distribution is calculated, since I have just turned 70 and a half in 2018, I'm going to look at my account value as of December 31st of 2017, which is the year prior to the year that I turned 70 and a half. Now, so I'm going to look at that calculation. The IRS is going to give you a formula that you're going to be able to use in order to determine what would be the minimum distribution that you must make at the age of 70 and a half. You can always take more, but you cannot take less. If you take less, any amount that you should have taken that you didn't take will now come with a traditional tax based on your tax bracket plus a 50% excise tax penalty. Yes, you heard me right. Failure to take required minimum distributions at the age of 70 and a half and beyond will force a 50% penalty to you and to your assets. So you have to be very careful when you start to consider and you start to get closer and closer to that 70 and a half age that all of us have to deal with. The other area in taking required minimum distributions is, well, if I turned 70 and a half in 2018, do I need to take it in 2018? Can I delay it a little bit more? And this only applies to the first time that you turn 70 and a half. The IRS basically says to you that if you turn 70 and a half, like in this exercise where I turned 70 and a half in 2018, I can either take the distribution by December 31st of 2018, the first distribution, or I can delay this distribution for 2018 and take it no later than April Fool's Day 2019. That's right. It's not January 15th, it's not January 1st, it's not April 15th, which is traditionally where all of you and all of us may file our taxes, but the IRS says that it's got to be no later than April 1st of 2019. So that means that in a perfect world, I could delay my 2018 RMDs until April 1st of 2019. The problem with delaying that distribution from 2018 to 2019 can bring other issues and concern to the table. And the decision is as follows. You have to do provisional income calculation, determine what your tax liability is going to be in 2018 versus 2019. For some of you, it may make sense for you to wait until 2019 to take the 2018 it might be better, and it would make more sense for you to take the distribution in 2018 and not delay it into 2019. And one of the major reasons why I say that, and that's why you have to work with a retirement strategist that can help you figure out all of those distribution issues, is that if you delay taking the 2018 distribution until April 1st of 2019, then by December 31st of 2019, you will have to take a second distribution, and then by December 31st of every year thereafter. So your taxes may actually be higher in 2019 than 2018. Why? Because now you have to take that 2018 distribution, which you didn't take in 2018, but you took prior to April 1st, and then you would have to take that 2019 distribution in that year as well. So that would create two distributions in 1 year, and depending on your tax bracket, depending on your standard deductions, depending on your exemptions, which are pretty much gone now, and depending on the credits that you may claim under your tax return, it might very well make more sense to take the 2018 distribution in 2018 and then 2019 distribution in 2019. Now, once you go through the 2018 distribution, then every year you must take your required minimum distributions by December 31st of that given year. So during this seminar, we had a lot of questions. And then the question is, okay, so what happens, Bert? And this question was asked at the seminar. What happens if I have a 401k? What happens if I have a Roth 401k? What happens if I have a Roth IRA and if I have a traditional IRA? Well, the rules of engagement are totally different. If you have a traditional 401k and a traditional IRA, then you must take minimum distributions out of your traditional 401k and your traditional IRA separately. You cannot use a distribution from an IRA to meet the minimum requirement distribution for 401k and or vice versa. So you have to be very careful about that. Now, so that's one issue. Now, the other issue is, well, what if you have in a traditional 401k, also the company that you work for allows you to make contributions to a Roth 401ks. Roth 401ks, although the distribution will be tax-free, Roth 401ks also have a required minimum distribution guideline. And the only way to avoid the guideline of having to take that minimum distribution out of a Roth 401k is for you to convert that Roth 401k to a Roth IRA in the year prior to the year that you turn 70 and a half. Once you convert a Roth 401k to a Roth IRA, then you're not going to have to deal with minimum distribution requirements because they are not applicable to Roth IRAs. Now, another question that arose out of this seminar, well, Bert, what if I have 3 or 4 individual retirement accounts, IRAs, and I also have a traditional 401k? Well, as we stated, the traditional 401k has its own required minimum distribution issues you're going to have to deal with, and you're going to have to take an RMD out of that core 401k unless you're still employed at the time of hitting the age of 70 and a half. If you're still employed, then you're not required to take that distribution. But if you're already retired, then the required minimum distributions for 401k distributions will apply as well. Now, what if you have, like I just said, 3, 4, 5 different IRAs that you opened over the years? What the IRS says is that as long as the accounts are like in kind in nature, meaning you may have 1, 2, 3, 4, 5 different IRAs, you don't have to take the minimum distribution requirement out of each and every one of those accounts. you can actually lump sum the amount of money and the amount of values that you have in, let's say, those 5 IRAs as of December 31st of 2017, because remember, I turned 70 and a half in my example in 2018, and then pick and choose out of those 5 IRA accounts, which one you're going to dip in to take the required minimum distributions that would be applicable to all of those accounts. So if you do have several IRA accounts, then you can actually use a lump sum distribution out of one account or maybe 2 accounts without having to have a minimum required distribution out of each and every one of those accounts separately. And the reason why the IRS gives you the ability to do that is because simply those are IRA accounts and they're like kind in nature. So the IRS thinks of those accounts as one account. So it does give you a little bit more leverage when you take your traditional 401k and you convert that or you transfer that to a traditional IRA, because then you'll have a lot more leverage from a business standpoint. There are other questions that came up regarding Roth contributions. You know, can someone make a contribution to a Roth after he or she is retired? The answer is no, because it requires earned income in order to make those contributions. Now, nevertheless, if you have traditional IRAs, so you have traditional 401ks, which are pre-tax contributions, tax-deferred growth, and taxable upon distribution, you do have the ability, whether you are retired or not, you do have the ability to do a conversion from a traditional 401k or a traditional IRA to a Roth IRA. And obviously, you don't have to have earned income in order to do that. Now, remember, if you're going to make that conversion from a traditional 401k or a traditional IRA to a Roth IRA, then you must pay the taxes in the year that you do that conversion. But once you do that, then for the rest of your life, that money is going to grow on a tax-deferred basis. And then you're going to be able to avoid the required minimum distributions in the future. So we had a lot of those questions that we had to deal with, and we spent probably 20 to 25 minutes just discussing the issues and concerns regarding distribution from those plans. Now, the other question is, well, what's better to have, a traditional IRA or a Roth IRA? Well, the answer is it depends. It depends on what your tax liability is going to be at time of retirement. Now, when you look at what is happening in the United States today, if I were to ask you, if you felt that you would be in a lower tax bracket now or in the future, or are the tax brackets going to be the same? Well, I would argue that for the vast majority of us, unless all of you and myself, we have been a complete failure in our financial life, there's a very high probability that taxes are going to be much greater in the future than they are today. Just think of it this way. The national debt right now is sitting at $21 trillion and counting. The unfunded liabilities for Social Security, Medicare, Medicaid, Medicare Part D, and the national debt is exceeding $114 trillion today. So the only way that the US government and Congress is going to be able to generate revenue is by increasing the taxes to tax-paying entities in the United States. So although we are now under the new tax law, we all have to remember that on the individual side of the house, the Tax Cuts and Jobs Act will sunset December 31st of 2025. So when you wake up January 1st, 2026, everything is going to go back to the old law in which taxes were greater at the time. And then obviously the same thing happens with the standard deduction. You know, if you're married filing jointly, your standard deduction for 2018 through December 31st of 2025 have pretty much doubled. You have gone to 24,000. So actually the 0% tax bracket that includes your deductions, exemptions, and credits have actually gotten larger. So therefore, your tax liability is lower today than it has been in the past. In addition to that, the tax brackets have been reduced. So the 15% tax bracket became the 12% tax bracket. So for all of you and all of us that are going to be filing taxes in 2019 for 2018, I think the vast majority of Americans are going to see a tax deduction when it comes to the tax filing in 2019 for 2018. So when it comes to required minimum distribution challenges, there are a lot of issues and concerns that you need to pay attention to. We also discussed in that seminar the issue of sequencing of returns and the fact that it has a tremendous negative impact on your retirement survival if you have to take money out of a plan because of required minimum distributions at a point in time where the market may be heading south and may be losing money. So that's where the double taxation comes into play. Your account value is decreasing because the market is dropping, and on top of that, you have no choice but to take required minimum distributions. You know, I thought it would be important for us to have a short webcast and cover this with you. Remember, my number one goal here at Cambridge and for all of you out there is to kind of help you change the way that you see things. Because when you change the way that you see things, the things that you see change. So again, feel free to reach out. You can reach out to me at area code 786-766-1042, or you can email me at my corporate email address, which is bert.salazar, S-A-L-A-Z-A-R, at Cambridge, F as in Frank, P as in Paul, LLC.com, or you can email me at Bert, B-E-R-T, at BertSalazar.com. Again, thank you for your time today, and we'll talk again soon.